This is Robert Kraft, and I'm your host on SNN Network. And with me today is John Lowy from John B. Lowy P.C. It's a law firm. John, welcome to this Wall Street View.
Hi, thank you. Good to be here.
It's great to have you on. So to get started here, what is your background and what do you do?
Okay, I'm an attorney. Been practicing law for more than 40 years. My law firm is John B. Lowy P.C. We're based in Manhattan, in New York. And basically, we specialize in two things: representing companies that are already public or representing private people that want to go public one way or another via some sort of public offering or reverse merger, RegA or S1, whatever offering makes sense to get them public one way or another.
Great. So the reason that I had you on today is that I wanted to discuss the article that you most recently published with us in the MicroCap review titled "The Do's and Don'ts for Private Companies When Reverse Merging." So to start, for those who don't know, what is a reverse merger and why do you focus on this pathway to going public for this article?
Well, first of all, a reverse merger is basically a way in which a private company can become public by technically being, quote, acquired by a public company. However, in the acquisition, the shareholders of the private company end up with a substantial majority of the total shares issued and outstanding. So that's why it's called a reverse merger, because it's, again, technically a merger, but the company being acquired takes over control of the combined entities.
Mm-hmm. And then why do you focus on this pathway for this article?
Well, what's happened over the last several years is it's become more and more difficult for private companies to go public in the traditional manner of some sort of an IPO, public offering. So what's happened is only the larger offerings that you hear about are the common ones. For companies that are so-called small to medium-sized enterprises, really the only way for them to go public is via reverse merger. And that's why it's becoming, it has been popular actually for many years as a way for smaller companies that qualify to go public.
Got it. So let's focus first on the do's for private companies when reverse merging. What are they, and then why should you do each of these?
Okay. Well, what I stress to clients is when they want to go public via reverse merger is any way and anytime you want to go public, it's a serious step in a corporate history. It's not something to be taken lightly. It's not something that you just rush into willy-nilly with no idea of what you want to do and how you want to get there and what's going to happen. So the first thing I always do is advise companies to get themselves surrounded with some good, solid professional help, be it attorneys, accountants, and other people that can guide you in this process of going public. Again, it's a serious step in a corporate development. Mm-hmm. Obviously, if they want to use my law firm, obviously there are other law firms that do it. And again, I would also always recommend that they get good, solid, professional accounting advice because you will need audited financial statements.
Right. Were there any other do's in there for some of these private companies that are looking to go public?
Oh, absolutely. Going public and being public can be, of course, challenging if you get in bed with the wrong people. So I always advise clients and of course we do that as part of our due diligence, check the backgrounds of the people that you're getting involved with. If you have any so-called bad boys, bad actors, stay away because that will affect the company negatively for years in terms of if they want to get listed, if they want to raise additional capital, they will find that someone will come up and check the due diligence and say, oh, you did business with this person, sorry, it's going to be a problem, and they pass. So again, very important. Check the backgrounds of the people you're doing business with. Mm-hmm. The other things that we also advise is keep in mind your shareholders can be your best supporters or, of course, your worst enemies. So always, I always advise people get a good investor relations firm because they are also an excellent way to get the story of the company out to the public. And it's a good way for them to communicate with shareholders. And again, the other important do is keep your shareholders and the public involved in what's happening, even if there's bad news, because the SEC rules, and this is obviously another do, make sure you comply with all the SEC compliance rules. Obviously, it's important. You want to stay out of trouble. You want to make sure that you're continued to be current in your public filings so you don't have problems there. And that's all part of being public. And again, it certainly takes time, but overall, as a general rule, a public company will be worth 3 to 4 times as much as the quote same, so to speak, private company. So there is a serious advantage in being public.
Got it. All right. So now for the don'ts. What are they, and why should you not do each of these?
Well, yeah, I mean, the don'ts are pretty much the opposite of what I've been talking about. Again, most important, stay away from the bad boys. Second, make sure that you hire people that are professional and experienced in this. Again, this is not for the faint of heart. Another thing is do your best to have a CFO, a chief financial officer who has experience with public companies. Also best to get a CEO who also has public company experience. If you're the owner of a private company and you want to go public, but you don't have any public company experience, it's very often a good idea to, as they say, kick yourself upstairs to become chairman of the company, but hire an experienced CEO. Also very, very helpful in terms of communicating with Wall Street and, again, putting the public company in the best possible light.
I like this one point that you made in the article that don't think that going public via reverse merger is a get-rich-quick deal. So can you elaborate on that a little bit?
Oh, it's also very important. When you go public, you've got to have a long view of what you want to do for this company, how you want it to grow, how you want it to prosper, etc. If you're going in public just to have a quick hit, you're going to be seriously mistaken. First of all, legally, there are obviously many limitations on your ability to quote, get rich quick in terms of selling your stock. So you better be in for the long haul, and to make sure that, again, that you have a vision for the company, that you want to make this company prosper, because again, long term, you're much better off doing that than trying to just get public quickly for the sake of being public.
Right. So then what would you say is the main takeaway that you want people to take with them from this article?
Well, I think the most important thing is what I said at the start of this interview, which is basically going public is a serious, important, but potentially outstanding step for any private company. Properly done with, again, surrounding yourself with the right people, staying away from the bad boys, you can make a ton of money and much more money being a public company than you can as a private company. Oh, also a couple of other significant advantages being public, which is the ability to raise capital, the ability to attract and retain qualified employees with stock option plans and other advantages of being public. So, not to mention your own personal net worth. Nothing wrong with that.
For sure. And I have to ask also, because you mentioned at the very beginning in your background that you help private companies looking to go public, whether it's reverse merger or through RegA Plus. What would you say is the difference between RegA versus a reverse merger?
Well, the difference is a RegA is, of course, a way of raising money. I want to make clear that if you do a reverse merger, the reverse merger itself does not raise any money for the company and usually costs you some money. A RegA Plus is a way to raise capital, keeping in mind that when you go the RegA Plus, again, you should have audited financial statements. It's going to take a few months. It's going to be expensive in terms of, again, hiring attorneys and accountants, and doing the proper marketing for a company if you want to go public via a RegA Plus. It's had RegA Plus has been around, I guess, for about 5 years now, and it's had mixed success. There have been some good companies that have gone public that way, and obviously some that haven't done as well. Again, proper circumstances, I would certainly recommend it.
So I have to ask too, because you've seen a lot of the different types of transactions going on, whether it's
Yes.
private companies doing a reverse merger or private companies looking to raise capital and eventually go public using RegA Plus. I mean, what are some of the trends that you're seeing right now where it's July 2019? You know, what are you seeing out there?
Well, I can tell you in terms of reverse mergers, where I've been involved with probably well over 100 at this point, it's still a very active market. There is still continuing demand for private companies that want to go public that way. RegA Plus, yes, also, especially in certain sectors, RegA Plus is working well. The two main areas where RegA Plus seems to be doing the best is real estate, because there's pretty much a targeted market there of investors who are looking basically for a steady return. So that's one area where RegA Plus has worked out well. And another area is certain parts of the tech sector also are doing well with RegA Plus.
I also have to ask too, because a lot of investors, you know, that watch our videos, they're focused mostly on small micro nano cap companies, and a lot of these companies tend to go public via reverse merger, and then they have a new management team and they're like, yeah, we're public now. Our old CEO did a reverse merger a while back. You know, how do you quell some of those implications of a public company that went public as a reverse merger? I mean, it seems like sometimes people think of it, oh, maybe it's not as high quality of a business because they did that route versus some other way of either going public or just staying private.
There used to be, years ago, there was a perception of reverse mergers as not the way to go public. It's for lesser companies, etc. What's happened is over the years is the SEC has changed the rules, making reverse mergers, frankly, more difficult, which as far as I'm concerned is fine, because what it's done is taken some of the weaker sisters out and kept some of the stronger ones in that go public via reverse merger. I think that also, I mean, huge numbers of companies that have gone public via reverse merger have ended up listed on whatever, the Amex, the NASDAQ, New York Stock Exchange. Several of them have been have sold to larger companies. So the previous taint about reverse mergers, I think, is pretty well gone. Also, for example, many of the larger accounting firms used to say, I don't want to touch a company that's doing a reverse merger. That's also changed. I think, in my experience, almost every large accounting firm that I've dealt with has not had a problem with a company that's going to reverse merge or has reverse merged.
Well, what are the advantages and disadvantages of a company doing a reverse merger versus let's just say, a direct listing?
Well, if you want to do a direct listing, a so-called IPO, your first difficulty, frankly, is finding an underwriter. The old days where you could find underwriters doing $5 million, $10 million, $20 million offerings, they're harder to find now. There are just fewer of those broker dealers around doing it. There are some, of course, but you've got to, number one, you've got to find those underwriters, and of course, very often wait in line. If they say, gee, I like your deal, or you have to wait until we do the next several deals, and you'll be public. So that's one of the disadvantages of going public that way. The big advantage is, of course, if it's successful, you've got money. The principal disadvantage of a reverse merger is, again, you don't raise any money that way. It costs money to go public that way. However, once you're public, it usually very substantially facilitates raising capital.
Right. So, John, with that, where can my audience go and find more information about you and your law firm?
Oh, sure. Again, we're based in Manhattan. The phone number is 212-371-7799. The website is John B. Lowy. Is johnloweylaw.com. JohnLowYLAW.com. And I'm John L. at John Lowy Law. So we certainly welcome people to who are interested in going public to give us a call.
John, thank you so much for joining me today. It was an absolute pleasure.
Thank you. My pleasure. Appreciate it. Thanks, Robert.
Thank you.